This is the ultimate dilemma for most investors, at least lay investors. What should they be focusing on? Profit growth of a company or revenue growth of a company? In assessing this, the one thing to understand is that the declared profit after tax, net profit or PAT as it is called, is often what the management wants to show. And a PAT number can be tweaked to a large extent, at least to some extent, by the management, depending on what it wants to convey to investors. This can be done in a whole host of ways. So PAT, as they say, is often an opinion from the management on what the inherent profitability is. Revenues are far more difficult to tweak. Sales are sales. I mean, you cannot fudge them unless you want to do something completely illegal. Therefore, often it is important to look at the PAT number. It's not irrelevant, but to also set a very high degree of importance on what the revenue number is, because the revenue number gives you a fairly or a better indicator of the underlying strength of the business and the growth in the business. And in addition to all of this, one should keep an idea on the EBIT numbers or the EBITDA numbers, which is the operating profit, which is a little bit more difficult to tweak than the profit after tax, and therefore it gives you a sense of the intrinsic profitability pattern of the business which the company that you're trying to buy belongs to. This is a mistake which a lot of investors make, that they take an investment call based on a single quarter's number, good or bad. That is a dangerous trap. Ideally, for long-term investors, they should keep an eye on profitability pattern over a period of time. Look at the last 2 years or 3 years performance of the company. What is the growth trajectory? How is the company delivering on various financial parameters over a period of time? That gives you a much better sense of the quality of the business rather than a single quarter's numbers. A single quarter's numbers can be very good for some reason, but it may not sustain. A single quarter's numbers can equally be very bad because of a factor which is just cropped up, a non-recurring factor. And therefore, you should be very careful about basing investment decisions on a single quarter. Look at a trajectory. Is the company's sales trajectory X% over a 2-year, 3-year period? Is the company's EBIT margin profile consistent at a certain level over a 2 or 3 year period? Sometimes trajectories over a period of time give you a much better sense of the quality of the business, and that is what investors should keep in mind while choosing an investment. The income statement is always very important because it gives you a sense of performance and growth of the company. However, it is important and difficult, this one is difficult for lay investors to determine, what is the underlying balance sheet strength of the company. Because sometimes a company can show fairly impressive income statements, but there is a huge amount of debt, either at the company level or at the group level or at the promoter level, which is getting masked by the numbers. So therefore, one must look at the balance sheet as much as one can. It's not as easy as looking at declared PAT or sales numbers, but one must make an effort to look at simple ratios like debt equity ratios, the absolute number of debt declared by the company, the interest coverage ratio, which tells you whether the profits of the company, cash profits or operating profit of the company, are enough to pay back the quarterly interest rate or the annual interest rate that the company has to pay because of the debt. So other than issues like profit, sales, even over a period of time, one must assess the balance sheet strength of the company, because often good companies are undone by the ambitious aggression in their balance sheets, and that is something which can lead to serious underperformance in stocks where even reported profitability is strong.